Hey y'all, welcome to my channel. It is Jessie D. It's so nice to be able to come to y'all with a new video. This one is about how to be the perfect home buyer. Now, before we get into my introduction, and it's new, can't wait for y'all to see it, but before I get into my introduction, I want to give y'all my credentials. My nickname is Jessie D. That's my business name, but my real name is Jessica Kirby. I'm a licensed realtor in Alabama and Georgia, and also a licensed mortgage originator in Alabama and very soon to be Georgia as well. My license number in Alabama is 102804. My Georgia number is 42565, and my NMLS number is 219-2371. I had to think. But today is going to be all about how to be the perfect home buyer, which I'm going to tell you what you need as far as credit and things like that. So if that is something that you're interested in, please keep on watching. So I need to crunch all this in 10 minutes. So I'm not sure how much in detail I'm going to be able to go into these steps, but I'm going to try to crunch as much as I can. Okay, so credit, which is probably the most controversial thing because people think it's the most important thing and really it's not. But the ideal credit score for a mortgage originator to be like, okay, let's go, is about a 620. A 620 score is not something that is hard to get. Usually, if you have somewhat of a year or so of payment history, even if it's like deferred student loans, 620 really is not that hard. If you have like one revolving line of credit, a credit card that doesn't have any missed payments, usually that'll get you there. However, a 680 is what we like to see because that one doesn't take any interest rate hits or anything like that, which means like it doesn't cost you a little bit more to get the house. You usually get a better rate. So let's say you get a 620, but if you can, try to aim for a 680 or a 660 is usually a good number as well. Debt. Okay, so this is actually the most important thing because you can usually find ways around this to be able to get you where you need to be at. So what most people don't know is that we don't care if you're $1 million in debt. What we care about is how much you pay on that debt monthly versus how much money you bring in monthly. Everything is on a monthly basis. So say I have $100,000 in student loan debt. If you are not on a zero payment, we count if you are on a zero payment, we count 0.5% of what you owe. So 0.5% of 100,000, I believe, is 500. That's what we count towards your monthly DTI, which means that is what is taken out of whatever you bring home a month. Like say I bring home 2,500, well, 500 of that we count of the 2,500 is the student loan payment, if you understand that. I'm going to go into detail later on this week about how to calculate DTI. So stay tuned for that this week as well. Credit cards. Try to keep the utilization below 30, prefer below 10%. Usually doesn't really affect your credit in a certain way. I know sometimes it can be hard if your limit is low on the card, but if you are in the process about to buy a home, you want to go ahead and get some of those debts paid down so that it can reflect on your credit score as good payments and not in a bunch of debt, okay? And it keeps your monthly payment down too. So say you're only like 20%, like 10% of your utilization. Usually that's like a small amount, like, you know, depending on the credit limit. Student loans. Okay, so if your student, like say you don't want to use the 0.5% rule, if it's gonna take you out of being able to own a home, say you owe like, you know, $200,000-$300,000 in student loans, what you have to get on is an IDR, which is an income-driven repayment plan, but it cannot be zero. So it needs to be like $50, $5, whatever, $1, anything but zero, so that we don't have to do the 0.5% rule. That is major. That recently was not always like that. I think it changed maybe like 2 years ago or something like that. To where we can actually use that rule now. So we can use IDRs if you can get on one of those that's anything but zero. And that will get you back in the game if your student loans are gonna disqualify you from owning a home because they're too expensive. Try not to have any late payments on your credit report that are in the last 12 months. Usually that can call, like, maybe look at you as high risk. That's something important to go in as well. And then reserves. So reserves is what we call money in the bank, money in retirement, money in a stock plan or anything like that. Those are what we call reserves, and they are what you need to have in the bank that makes you look good, even if it's like a 401k. And what I mean is that if my payment's $1,000 and the bank wants to see 3 months of reserves, that means I need to have $3,000 somewhere. The good rule of thumb is to have 3 to 6 months of reserves, and usually that's pretty good depending on your credit and the other things on your file. Everyone's different. Some people don't have to have reserves. I know VA doesn't really have to have reserves, so it just kind of depends on the loan product that you're using. Now, let's talk about loan product. There are 4 loan products: conventional, FHA, VA, USDA. Conventional is good if you have a high credit score. Then the PMI on it is not expensive. And what PMI and MIP is mortgage insurance to protect the lender, that you have to pay now to protect the lender from you defaulting. So every month you have to pay a little bit toward that account in case you ever default. Now, how to get rid of that? There are ways to get rid of that where you don't have to pay that. If you can put 20% down on your house, then you'll never have to pay it for the life of the loan. But if, say, you get into a house and the house appreciates 20% in equity, which means if my house is worth, if I paid $100,000 for my house and it's worth $100,000, when my loan gets to $80,000, I can do a conventional. If I'm in FHA or VA, I can do conventional, or if I'm already in conventional, I can request them to drop my PMI, which is my mortgage insurance, which will make my payment go down, because it's probably like $100 and something a month. Depending on how much your loan amount was. So that's definitely something that you want to get rid of as soon as possible. If the next loan, which conventional is the best loan if you have 20% down, it's just the best. FHA. So FHA is the most common home loan because it's easy to qualify. FHA, you can get one with a 580 credit score. You can go, your back end DTI can be like 57%. It's just the easiest one to qualify for. Most people qualify for FHA because it is easy to get, and you only have to pay 3.5% down on your home. That is the most common. VA is for people that have served in the armed forces, so Navy, Army. It's one of the best. They don't have PMI. They don't have down payments. It's one of the best loans out there. If you are over 10% disabled, you don't even have to pay the funding fee. So it is one of the best loans out there. If you are married to someone in the armed forces or in the armed forces yourself, that is one of the best loans that you can get. And they're easy to qualify for. Last, USDA. So it's like for rural areas. And don't think this is like in Texas or Kansas, somewhere like that. It's anywhere that's outside of like city limits. Where I live qualifies for USDA. Now, this loan is no down payment as well, but however, it is a little hard to qualify for because they don't do a lot of debt. Now they're starting to want like more money in reserves, things like that. So you just kind of have to go onto the website, on the USDA website, and run the address and see if it qualifies for the area qualifies for USDA. But it is a very good loan. There is mortgage insurance on it, but it's cheaper than FHA's mortgage insurance. And USDA, like I said, no down payment, so that's a bigger thing for them. But however, you can't go that high up in back end on USDA. Okay, and I think that pretty much sums up what we needed to talk about as far as what I need to own a home. I know this video was quick, but I'm gonna go into detail this week about each one. So I'm gonna break down credit, I'm gonna break down debt, I'm gonna break down reserves, I'm gonna break down also the job length history that you have to have, which is 2 years. That's the last one I forgot. You have to have 2 years on the job, or if you're a student, we can use your college credits as your work history. But I think that's pretty much it as far as the overview of what we're going to do this week. And just be looking out. Today's Monday. I'm going to upload a video every day on what you on the each one to break down exactly what we need to do. Okay. Thank you so much for tuning in. I definitely appreciate it. It's your girl, JCD. Please subscribe to my channel and share this video with somebody that is looking to be a homeowner. Bye.